Okay, let's dive right into this explainer and uncover how an elite group of Americans structurally protected their savings during the greatest banking collapse in history. We spend so much of our lives, literally decades, working to build our savings. We learn how to earn, we learn how to invest, but very few of us are ever actually taught the mechanics of how to structurally protect those hard-earned savings from a massive institutional failure. It's just a huge blind spot for most folks. So today we are going to look closely at the exact strategies used by the survivors of the 1929 crash, and more importantly, we're going to break down how you can map those exact same historical strategies onto the financial institutions that are available to you right now. Now, to really grasp this, we have to understand the sheer scale of the historical loss, which is frankly staggering. Between 1929 and 1933, more than 9,000 commercial banks in the United States permanently closed their doors. Imagine waking up and realizing the institution holding your life savings is just gone. Depositors withdrew approximately $6.8 billion in an absolute panic, and out of that amount, they lost roughly $1.36 billion to insolvent institutions. When you adjust that into modern purchasing power, to put it in today's terms, depositors lost the equivalent of $28 billion. That is an astronomical amount of purchasing power wiped out. And here's the kicker. The vast majority of these people did absolutely nothing wrong. They simply trusted the institution holding their money. But here is the truly fascinating part of the story. Roughly 8 to 10% of cash holders during those early Depression years lost absolutely nothing. Zero. They kept their entire savings intact. Now, you might be wondering, were they wealthier, better connected? Did they just get lucky? No, they weren't any of those things. They simply kept their cash in a completely different structure. It was a deliberate government structure designed specifically to bypass private bank balance sheets entirely. In this explainer, we will be covering, first, the 1929 banking secret, second, modern bank failure risks, third, the four-layer cash framework, and finally, securing your access framework. Let's start with Section 1, the 1929 banking secret. Look at the timeline of this incredible mechanism. Back in 1910, the U.S. Congress passed the Postal Savings System Act. This created a completely parallel deposit system operated by the post office, which began accepting deposits on January 1, 1911. It paid a 2% annual interest rate. And, crucially, this is the most important part. It was backed by the full faith and credit of the United States Treasury, not a private commercial bank. So, through the early 1930s, as those 9,000 commercial banks collapsed all around them, deposits at the postal system absolutely skyrocketed, from $200 million to over $1 billion, eventually peaking at $3.4 billion in 1947. And through all that chaos, not a single postal saver lost a penny. It was arguably the most successful consumer protection program in American banking history. But, as you can see, it was quietly abolished in July of 1967. Why did that happen? Well, the commercial banking industry had spent 40 years heavily lobbying against a government alternative that didn't pay them fees. They wanted those deposits. However, the exact functional descendant of that resilient system still exists today in 2026. It is operated directly by the U.S. Treasury Department under the name TreasuryDirect, and it requires no bank, no broker, and zero monthly fees. Moving right along to Section 2. Modern bank failure risks. Now, you might be thinking this is all just ancient history, but let's look at why these structural vulnerabilities are perfectly relevant to anyone holding significant cash today. Consider the story of a retiree named Patricia. Her experience perfectly illustrates what happens when you keep everything in one single place. Patricia combined her late husband's life insurance and the sale of a property into a single high-yield savings account at a regional community bank. Her total balance was a little over $315,000. Well, when that bank failed on a Saturday in March, the FDIC arrived on the scene. But their insurance limit is strictly capped at $250,000. The excess $65,000 she held was completely unprotected and not recoverable through the insurance fund. But listen, the nightmare didn't just stop at the loss principal. It gets worse. The FDIC took 8 business days to transfer her insured funds to a temporary holding account. During that freeze, Patricia missed a property tax payment, which slapped her with a massive late fee. Then, she missed her supplemental Medicare premium autodraft, which triggered an overdraft notice, even more late fees, and actually caused a cancellation of a cardiology appointment because her insurance couldn't be verified in time. Eventually, she did get a partial recovery of those uninsured funds, about 47 cents on the dollar, but she had to report that recovery as ordinary income, which added over $4,000 in completely unexpected federal tax liability. Talk about adding insult to injury. This is the devastating cascading reality of holding uninsured excess cash in a single commercial bank. And this danger really compounds when we look at 2 other common traps that catch smart people off guard. Let's start with Robert. Robert thought he was fully protected, right? He had $190,000 at a regional bank, which is well under that $250,000 FDIC limit. What he didn't realize was that his regional bank had been quietly acquired by a much larger national bank where he already held a checking account. This consolidation merged his accounts under a single federal tax identification number, pushing his newly combined balance to $212,000. Now you're probably thinking, okay, that's still under the limit, right? It is, but when that acquiring institution started showing signs of financial stress, Robert was subjected to a 9-day liquidity freeze because the bank was intensely monitoring capital outflows. The lesson here is that the bank you signed up with 30 years ago is not necessarily the legal entity holding your money today. And then there is Joyce. Joyce did what a lot of financial planners consider the safest possible strategy. She built a $250,000 certificate of deposit ladder. But when her bank failed, she learned a very harsh lesson about how federal insurance actually works. You see, the FDIC protects your principal, absolutely, but it does not guarantee immediate liquidity for time deposits. So the FDIC simply honored the original maturity schedules of her CDs. What did that mean for Joyce? It left her funds frozen for a full 42 days, causing her to miss multiple critical living expenses. Imagine not being able to touch your own money for a month and a half. To really understand the urgency of this, let's just observe some neutral, purely factual indicators from the past 60 days alone. First, a community bank in Chicago failed, and while the FDIC processed the claims, depositors lost access to their funds for an agonizing 11 days. That's nearly 2 weeks of zero liquidity. Second, congressional leaders from both sides of the aisle are currently discussing whether to raise the federal deposit insurance limit from $250,000 all the way up to $10 million. You really have to ask yourself, why is the current limit suddenly being viewed as completely inadequate by lawmakers? What are they seeing? And third, the Trump administration has signaled in 3 separate public communications that it is actively evaluating whether the Federal Deposit Insurance Corporation should be folded directly into the Treasury Department. These are exactly the types of structural stress indicators that the people who survived the 1929 collapse would have recognized immediately. It's the writing on the wall. Let's move on to Section 3, the 4-layer cash framework. Okay, let's dive into the definitive solution that structurally eliminates this single point of failure exposure across your entire portfolio. This 4-layer cash protection framework descends directly from that successful 1929 survival strategy, but we've translated it precisely into the modern institutions and accounts available to any American right now. The average retiree who is completely exposed to bank failure usually has all of their cash stuffed into a single layer, usually their primary commercial bank. But a retiree who implements these 4 distinct layers has structurally eliminated their single point of failure, regardless of which commercial banking institutions happen to be healthy or unhealthy on any given Tuesday. It is like building an impenetrable shield around your money. Let's break down exactly how you construct each layer. First up is Layer 1, your operating cash. This is the money you need for your monthly bills, groceries, and day-to-day spending. You want to keep this at an FDIC-insured commercial bank for convenience, but you must keep the balance strictly under the federal insurance limit. And here is a critical piece of homework for you today. Verify the current insurance status of your bank at fdic.gov/bankfind. Pull out your monthly statement and verify that the federally insured legal entity name printed at the bottom actually matches the bank you thought you signed up with. If that legal entity name has changed due to some hidden merger in the past 5 years, your insurance coverage may have consolidated right along with it without you even knowing. Keep only 1 to 2 months of typical living expenses here, no more than that. Moving right along to Layer 2, your protected savings. This layer should be housed at a local credit union. Why? Because credit unions operate under the National Credit Union Administration, or NCUA. This is a completely separate federal insurance system from the FDIC. They operate under entirely different statutory authority, they do not share funding pools, and crucially, they do not share failure risk. It's like having a backup generator hooked up to a completely different power grid. If you hold $250,000 at an FDIC commercial bank and another $250,000 at an NCUA credit union, you are independently insured for both balances under 2 entirely different federal systems. It's a brilliantly simple way to immediately double your systemic protection. Next is Layer 3, which relies on a hyper-specific physical cash rule utilized by those 1929 survivors. You should hold between $2,000 and $10,000 in a fireproof safe in a discrete location at home. But the absolutely most important part of this strategy is the denomination of the bills. You must hold this in denominations no larger than $20 bills. Now, why 20s? Think about it. During the Great Depression, people holding 50s and 100s found that local merchants simply could not accept them for routine purchases. The merchants didn't have the change in the register. Small bills, 1s, 5s, 10s, and 20s, are the true lifeblood of local liquidity during a banking freeze. Now, I need to give you a quick, vital warning right here. When you go to your bank to withdraw this cash, do not structure multiple smaller withdrawals over a few days to try and evade the federal bank reporting requirement for cash transactions over $10,000. Structuring withdrawals to avoid that report is a federal offense. Do not play games with federal laws. Just make a single, declared withdrawal, cheerfully accept the routine paperwork, and move on. Finally, we reach Layer 4, TreasuryDirect. This is the absolute foundational bedrock of your long-term savings. You can go online and open an account at treasurydirect.gov in about 20 minutes using your Social Security number. Just like the original 1910 postal savings system we talked about, this bypasses commercial bank balance sheets completely. There is no middleman bank in the chain that can fail, there's no broker taking a cut, and there are zero monthly fees. Your money is backed directly by the full faith and credit of the United States Treasury. Furthermore, the interest paid on these securities is totally exempt from state and local income tax under Section 3124 of Title 31 of the U.S. Code. So for those of you living in high-tax states like California or New York, this tax exemption can be worth an additional 0.7 to 1.2% in after-tax yield compared to a standard bank savings account. That is a massive advantage. Inside your new Treasury Direct account, there is a specific, incredibly powerful instrument you really need to know about: Series I savings bonds. I bonds are incredible tools. They pay an interest rate composed of a fixed base rate plus an inflation adjustment that updates every 6 months to keep your money's purchasing power safe. Right now, the combined annualized rate is sitting nicely between 4.3 and 4.8%. Just like other Treasury securities, they are completely exempt from state and local taxes. But here is the real secret weapon. They can also be completely exempt from federal income tax under Section 135 of the Internal Revenue Code if the bonds are used to pay qualified higher education expenses for you, your spouse, or a dependent. Let that sink in. If you are a retiree with grandchildren approaching college age, this is arguably the single most tax-efficient savings instrument available in America today. It's a literal game changer for college funding. An individual can buy up to $10,000 electronically per year, plus you can grab another $5,000 in paper bonds by overpaying your taxes and requesting your refund in I-bonds. Finally, let's look at Section 4, Securing Your Access Framework. You see, protection without succession planning just leaves the next generation completely locked out. So let's examine this final, heavily overlooked element. Consider the cautionary tale of a man named David. David is a 69-year-old retiree who did everything right, or at least he thought he did. He perfected his 4 layers. He had his operating cash, his credit union, his home safe, and he had $110,000 sitting perfectly protected in Layer 4 with TreasuryDirect. So when a major community bank failed in his state, David didn't lose a single second of sleep. He was structurally protected. But shortly after that event, David suffered a sudden medical emergency. His daughter, who was managing his finances, went to access the TreasuryDirect account to cover his mounting medical bills and found herself completely locked out. Why? Because TreasuryDirect does not, by default, honor a standard general power of attorney drawn up by your local lawyer. Without specific advanced documentation filed directly with the Treasury ahead of time, David's daughter couldn't touch those fully protected funds when he needed them the absolute most. To fix this massive gap, you must explicitly document access for every single layer you build. Treat it like a checklist. For your commercial bank and your credit union, you need to physically go in or log on and file a payable on death or POD designation form. For your physical cash in Layer 3, you must write a clear, concise letter to the executor of your estate identifying the exact, discrete location of the safe and exactly how to access it. Don't make them guess. And critically, for your Layer 4 TreasuryDirect account, you must go to their website and file their specific secondary access form. Do not just rely on your standard local power of attorney. If you don't file the Treasury's specific forms in advance, your family will be hitting a bureaucratic brick wall trying to access your foundational savings during an incredibly stressful time. So when we put this all together into a complete structural picture, you can really see how it forms an impenetrable shield around your hard-earned savings. Layer 1 provides your daily frictionless liquidity. Layer 2 doubles your federal insurance by utilizing an entirely separate NCUA fund. Layer 3 gives you absolute system-independent physical liquidity in perfectly usable denominations during a crisis. And Layer 4 anchors your core wealth directly to the U.S. Treasury, bypassing commercial risk entirely while offering incredible tax advantages. When you pair this robust system with those advanced access forms we just talked about, you completely eliminate the single point of failure in your financial life. Now, to help you implement this immediately and flawlessly, the source material for this explainer offers a truly fantastic resource, a completely free 47-page retiree protection checklist. It's incredibly detailed. It includes the exact federal lookup links for verifying your FDIC and NCUA legal entity status, step-by-step screenshots for opening your TreasuryDirect account without getting confused, and handy allocation worksheets to figure out exactly how much of your cash goes into each layer based on your specific monthly living expenses. It also contains the specific TreasuryDirect secondary access forms you need. And, as a bonus, if you're shifting funds around and earning that new tax-exempt Treasury interest, the source provides a discount code, GRAVES, for TaxLayer Pro, giving you 25% off the federal filing tier to ensure all of your new layers are reported perfectly to the IRS. Okay, I want to leave you with this final vital question to ask yourself today. Really take a hard look at your accounts after this. If your primary bank failed tomorrow morning and you were locked out for 2 full weeks, does your cash have a single point of failure? Would your life grind to a halt? The structure used by the survivors of the 1929 crash is not a secret in a legal sense. It is fully documented, perfectly legal, and entirely free to set up today. But it functions like a secret because commercial financial institutions have absolutely zero interest in telling you how to move your money off their balance sheets. They want your deposits. It's up to you to take control of your structure, eliminate your single points of failure, and build your 4 layers. Thank you so much for joining me on this explainer. I hope this was eye-opening. Keep learning, keep organizing your protection, and I'll see you in the next one.